Hello everyone, and welcome to today's webinar, where we'll be discussing digitalization in the commodities market and demonstrating powerful tools you can use to generate deeper insights from oil trading data. My name is Candice Ting, and I am a Refinitive Data Management Solution Consultant for EMEA from Refinitive based in London, and I'm also your host for today's webinar. I'm delighted to have you here, and I'm looking forward to facilitating the discussions with our expert speakers, which are coming up very shortly. We'll also be doing a deep dive into the value that can be created through data digitalization and the tools you can use to generate sophisticated visualizations and make smarter trading decisions. Now, before we begin, a few housekeeping notes. At the bottom of your screen, you'll find multiple widgets for you to use and access, such as speaker bios, webinar materials, technical support, and a survey to capture your thoughts and views on the discussion. All widgets are resizable and movable, so please feel free to move them around to get the most out of your screen space. We'll be walking through Python example use cases through the media player. So if you want to maximize that whilst we are discussing and sharing our screens, please do so. We'll also be recording today's session. So if you have any questions during the webinar, you can submit them through the Q&A box, and we'll try to answer them during the Q&A session at the end. But if we run out of time, they will be answered later by email. Please know we do capture all questions. For the best viewing experience, we recommend closing any programs or browser sessions running in the background. This will help conserve your bandwidth. Should you experience any issues, you can refresh your page or reach us via the Q&A for support. We value your feedback, so we would love for you to complete the pop-up survey at the end of the webinar. The webinar recording and resources will be shared via email post-webinar. On our panel today, I am joined by Jakob Bloch, CEO of Commodity Appointment. Also joining on the panel is Alessandro Sanos, Global Director in Sales Strategy and Execution, Commodities at Refinitive. To walk us through live examples in Python, we also have Alex Putkoff, Developer Advocate from Refinitive, and Jeffrey Smith, Director at Oil and Shipping Research at Refinitive. To kick things off, we'll be having a short panel discussion to look at current trends and topics we are seeing in the market today for developers, analysts, and traders. Then we'll show you how Python and Refinitive's APIs can work together to unlock data across the supply chain and generate exclusive insights into supply trends and buying patterns so you can gain a competitive edge. Following that, we will end with a Q&A session. Today, Jakob and Alessandro will be sharing their insights on the transformation that's happening in the oil market. One of the buzzwords that we hear a lot these days is digitalization. So in the context of its adoption amongst the commodity players, can I come to you first, Jakob, to talk about what are we seeing and what's the current landscape like? Thank you.
Thank you, Candice, and warm welcome to anybody who's logged in for this and to the rest of the panel. Yeah, Candice, I'm equally intrigued to take part in this session to understand more, because actually I think my sense from the marketplace is that monetization is harder, not easier. So then there are more tools available, clearly. But I'm not seeing anybody cleaning up, so to speak, when it comes to cleaning up using digital tools. So I think we're clear that a digital strategy will remain the icing, not the cake itself. You still very much need the fundamental play. So the strategies on their own, I don't see any outright winners. Traders still very much needed, so I don't think traders need to rethink their careers just yet. But fundamental trading, certainly the typical traders with the increased transparency in the market have lost their historical edge. the playing field is leveled. So I suspect what we're going to hear from your esteemed colleagues around, how we can track movement of goods, indices, road traffic, vessel tracking, weather, apply machine learning and AI and so on. It all sounds great. I'm intrigued on how that actually is going to pay the school fees. So, and I'm sure so are many others who've logged in, and certainly a number of the stakeholders that I know in companies are looking towards that. So I'm not seeing an enormous amount of success story on a pure digital agenda. I'm seeing non-participation being a disadvantage, however. So there is an element of you needing to get the toolbox complete in order to have a competitive platform, also in terms of attracting talent, as well as giving them the tools to perform. That's what I'm seeing.
Great, thanks, Jakob. Now, if relating to the landscape just outlined, Alessandro, could you tell us what shifts have you been seeing in oil trading, if you can expand on that? Thanks.
Thank you, Candice. And I would say that, like many other industries, the sector is facing a period of unprecedented challenges, but also opportunities. COVID-19 was a wake-up call for companies to have a plan to deal with disruption, and companies in the sector had to quickly adapt, and in parallel, to start planning the response to the changes brought by the energy transition and the Paris Agreement. So from what I've seen is that these changes factors have put the digitalization agenda on the fast track. And industry shifts in oil trading are nothing new, as to remain in business, companies always needed to adapt. But the rules for success have changed, as the pervasive use of technology into all areas of the business and the speed of change have reached levels that we have never seen before. So when I speak to CTOs and heads of trading desks, they often tell me that their people spend a lot of time and resources on managing data. Today's information-rich environment, data is being democratized, and the number and variety of new data sources are continuously increasing. So it's not unusual for an analyst or a data scientist to spend up to 80 or 90% of their time just managing data. And after they discover a new data source, they need to ingest it, to map it, and spend time in normalizing, as different sources often come into different formats. And then they need to commingle these sources with the proprietary data that they have in the systems. So the shift that I'm seeing is that data management is emerging as a new competitive advantage. That is being democratized, and virtually all energy traders and analysts can access data sets that were not previously available or affordable. So what is becoming increasingly critical is how well, but also how quickly, oil trading companies manage different data sources, how they can blend different market data with their proprietary information, and then apply technology to generate insights that they can seamlessly distribute across the organization to make informed decisions ahead of their competitors.
Thanks, Alessandro. So if I can just come back to you now, Jakob, who's winning in this space, if we can talk more about that, and what are they focusing on? Jakob, can you hear me?
Sorry, I was following your guidelines of muting myself when I wasn't speaking. So that was
no problems.
I should be practicing that by now. Right, who's winning and what are they focusing on?
Yes.
I might be stretching the discussion a little outside some of the boundaries of the subject matter here, but I think overall it's certainly the key is blended approach. I think I understand the fundamentals, but actually where I'm seeing the real differentiator is also having a deeper understanding of global money flows. And lots of that money flow is not actually derails the fundamentals, and here we're talking, capital allocation, indices, risk premia, and the banks have historically have access to much better flow and with that information relating to this particular subject, but then ultimately banks have then become much less active in commodities over time. So I think having a better understanding of the flows allows allows traders and companies to understand consequences between markets. That's one aspect that's worth spending time on. The second aspect is really understanding sentiment of news sources. And here I'm actually talking the simple impact on herd mentality when it comes to headlines. And simply counting the repeat of certain headlines in the global context has an impact on prices. So here we're talking, for instance, when Jeff Curry comes out with a statement such as "no one wants to be left behind," or you search on COVID plus Brazil, or African swine flu, or if we go back a little while to the previous president, everybody were trading Trump tweets when it comes to the axe market because of the trade war with China. So I think having an angle and a strategy on that is important too. But the other aspect around understanding the money flows that derails the fundamentals is really more about sizing positions correctly, getting your entry and exit right. It doesn't mean that the fundamentals don't count, but it does mean that if you come to the table with a pure fundamental strategy, you may come short on what could be a right idea, but you're not getting out of it what you should. So I think it's around be aware, be ready to adapt. Otherwise, your drawdown exposures will be impacted. And of course, no trader want to be closed out on what was ultimately a correct position. But that I've seen happen again and again.
Thanks, Jakob. Thank you for that. Alessandro, so in terms of, I guess, we mentioned about adaptability by Jakob. So how do you feel energy trading companies should prioritize new technology projects?
So I think that when I speak to market players about data and technology, I really cannot avoid noticing how heterogeneous the industry still is. Oil trading firms range from nimble and tech-savvy firms to big companies with a nightmare collection of different technologies that are increasingly expensive to license and manage, and any possible declination between these two extremes. So from my experience, success will result from a continuous anticipation process rather than a series of distinct and disjoint technology projects. What is key is to have a disruptive vision, a willingness to experiment, and a strong support and commitment from team's leadership. At the same time, I think that it is crucial to get the basics right. It is somehow self-defeating to start investing in the latest technology buzzword if the basics are not there. When oil trading companies are considering leveraging, machine learning, artificial intelligence, robotic process automation, or even data analytics, it is really key to start building from a strong data foundation. Otherwise, all these exciting technologies will not be able to deliver on the promise. So when I think at the future, at the rise of these new exciting technologies, I'm not a big fan of dystopian views of the future. And on this, I agree with Jakob. I do not believe that in oil trading, machines will replace humans. What I believe is that smart humans will be enabled by smarter machines. So the digital transformation in oil trading is as much about transforming the business as it is about empowering talent.
Oh, thanks for that, Alessandro. Now, if I can just stay with you for the next question actually in relation to that, what would be your top 3 tips for energy trading companies embarking on digitalization?
So I would say that the first tip is the importance of getting the basics right. This is really essential, and it should really be the starting point. In the excitement of exploring or adopting the latest technology buzzword, sometimes this step is overlooked. The majority of new technologies in oil trading need a reliable data layer, as we said, that companies can really trust. The second tip is that to channel the multitude of different data sets available, companies need a data management strategy for collecting, processing, and acting upon the tidal wave of data. all the new information sources available allow traders, analysts, and data scientists to explore the market from various angles. But this data tsunami can really be overwhelming, as they will be facing the inevitable issues around data integration, data enrichment, tagging, infrastructure, and so on. So if data management were easy, all energy trading companies would already be doing it. And this is where, as Refinitive, we can assist oil trading companies with that vantage point and have a holistic view of their ecosystem. Imagine having an in-depth view of current and forecasted demand of a given oil grade, a granular view of global supply, advanced data analytics, full insights on trade flows, and so on. And after this panel, my colleagues will show some practical and hands-on examples. Coming to the third tip, and from my discussion with clients, the best way to approach the digitalization challenge is to think big, but start small. Look at your value chain, recognize your advantages, and then, guided by the broader business strategy, identify a match, or maybe just find a compromise between the specific needs of your company and the available technologies that can solve those needs. So my suggestion would be to focus on those solutions that can scale fast and that, of course, are within budget. Because this approach lowers the total cost of ownership, protects oil trading companies from a never-ending implementation phase, and also frees us the time of the traders, analysts, and data scientists, who will now be able to focus on their job instead of spending the majority of the day fighting with different data sources. So think big, but start small, and take small steps you can build on over time.
And if I can just chime in there, Candice, also, I think just dovetailing what Alessandro just said, I mean, one of the small steps, I think, coming in is if you can get proximity to the CEO, this is very relevant, because you want to really sanity check how invested the CEO is in the project. And I do appreciate that some organizations that may not be possible, but many organizations that I work with are agile, and the CEO is absolutely available, and in many cases actually very invested in getting smart people on board. So generally speaking, this individual is there for questioning. So you need to understand from him or her whether the digitalization agenda is understood, let alone sponsored, to really get a sense of whether this agenda is going to stand the test of time, because it is a challenging campaign, and there is no quick buck either. So I think it cannot be overstated to do that. You know, Alessandro referred to it as the, test the buy-in from the leadership team. Yeah, that means getting some time with the CEO to actually say, how important is this to you? And do you visualize getting to the finish line on this, or are we merely keeping up with our neighbors? So I think that is a really important aspect. So yeah, I'm with you on that one, Alessandro.
And I couldn't agree with you more, Jakob, because implementing disruptive technology without disruptive thinking and the backing from senior management is just not possible.
Oh, thanks both. That's really good. So I just wanted to ask, so Jakob, so if we can just conclude the panel discussion by talking about just generally what the main hurdles are for individuals driving this digital agenda inside trading shops for our audience. Thank you.
Yeah, whether the individual is head of advanced analytics or some other label, normally these individuals are quite hands-on. So main hurdles, I mean, just vaguely going back to my last point about ensuring that there is an alignment with leadership, there is an alignment with the CEO. So before you stand a chance of having an influence on the shop floor level, you need to ensure that you've got some comprehensive sponsorship behind you. That's one thing. So then you need to get the agenda right. Now, the agenda here I'm referring to is in the front office. You may feel some resistance from competing with the traditional trading approach. So that may manifest itself in actually just resistance from people. So that calls for some human qualities in terms of how you overcome that type of resistance. Nothing new in that, but expected. You're selling something which is meant to be complementing, not competing. But that's not a given. On the day you walk in, that's not a given. So that's a task. With that task, I say, comes the challenge of gaining credibility with the trading teams, credibility with the front office. Be part of that. Be part of the traders' fundamental world. Help play a role where you join the dots, where you show value addition through better shaped trading. Traders will soon like you if they see that you're enhancing their own strategies and their own activities rather than competing with them. So it's optimization of strategies. That's a lingo that traders will understand and like. So once you've bedded down those principles and you've got the support and you've got the support from the floor, you've got the support from above, then that's a very fertile ground for paving the way for really pushing ideas in this space. So get some of those baby steps right in terms of the buy-in before you start bringing out the big science guns in terms of what you can do. So it's the small wins, the quick wins that will ease that buy-in process. So those would be some of the hurdles and how to overcome them for leaders in the advanced analytics space from my point of view.
Thank you. And like Alessandro said, think big, start small, for sure. So thank you, Jakob and Alessandro, for your valuable insights and perspectives on the current landscape around digitalization in the oil market and the strategies companies can adopt to be successful in their data digitalization journey. So just following on from the final point about hurdles commonly encountered with digitalization, at Refinitive, we're working hard to help solve these challenges for our customers. The Refinitive Data Management Solution, or RDMS for short, serves as an aggregator to merge and normalize data across a range of disparate sources, then disseminated via TRM, Excel, dashboard, or scripting output forms. It enables you to make the best possible use of your data, technology, and human or artificial intelligence, and facilitates the consumption of big data in a logical and structured manner, so you can extract maximum value from internal or external data sets at a lower cost. Alex and Jeff will now take us through 2 example use cases to demonstrate how RDMS and ICON can be used to generate powerful insights. Alex and Jeff, over to you. Thanks.
Thank you, Candice. Let me share my screen to do the demonstration. One of the factors that facilitates digitalization in the commodities markets that Jakob and Alessandro discussed is the democratization of the technology. Traditionally, to analyze vast amounts of data, you needed heavy and expensive systems, professional software developers to create and user applications. An analysis that a typical professional end user would be able to do was limited to what could be done within the constraints of Excel. With the advancement of technology, we now have new tools that end users can utilize by themselves without the overhead of heavy and expensive systems. Cloud computing and data storage, which is now available to anyone, makes unlimited capacity available at marginal and incremental cost. And younger generation of market professionals is generally more tech-savvy and far less averse to dipping their toes into writing custom code to analyze data. Relatively easy to learn and to use Python programming language got established as the tool for analyzing data sets preferred by many, in large part because of the abundance of ready available and constantly evolving open source Python libraries for all kinds of purposes, including artificial intelligence and machine learning. Jupyter, which allows one to write code, execute it, and display the output, all from the convenience of an internet browser, is another example of the democratizing technology tool. The example that I'm going to demonstrate is entirely implemented as a Jupyter notebook with only a handful of lines of Python code, because most of the programming work is already implemented in open source libraries that are freely available to anyone. Once the model is implemented, it can be run at any time. I just executed the code in this example right before this webinar, so the data set we have here is up to the minute. And of course, the advantage of these tools is that the model can be constantly evolving as you get new ideas, access to new data sets, et cetera, et cetera. And now, without further ado, let's look at this example. The official U.S. crude exports figures are available from U.S. Energy Information Administration, or EIA. However, these figures are published with a 2 to 3 month delay. Today, in the middle of May, the latest figures available from EIA are for the month of February. In the world of alternative data sources, could we reliably estimate U.S. crude exports ahead of the official figures? Refinitive provides real-time trade flows. In this block of code, I retrieve dirty flows with load country filter set to USA or US Virgin Islands, and the product filter set to crude oil. And here is a small sample of data. For instance, we can see that on May 17, a Suezmax class tanker named Pegasus Voyager is carrying just under 850,000 barrels of crude from Pacific lightering area to San Francisco, and a VLCC, or a very large crude carrier named Olympic Lion, is being loaded with just under 2 million barrels of oil at the port of Corpus Christi for departure on May 19. To produce an estimate for monthly crude exports, we need to aggregate the flows into time intervals. For this purpose, it's useful to add a number of columns detailing departure and arrival, week, month, quarter, and year, and this is what I do in this block of code. And now we can analyze the flows by geography. For the purpose of this exercise, Myanmar discharges are treated as imports by China, as the Sino-Myanmar pipeline feeds the refineries in China provinces bordering Myanmar. The trade flows data includes all crude transport. At the moment, there is only one US facility, the Louisiana Offshore Oil Port, or LOOP, able to accommodate a fully loaded VLCC, or very large crude carrier, a type of oil tanker able to carry approximately 2 million barrels of crude oil, and which is required for long-haul economic transportation of crude across the ocean, such as from the US to Asia. All onshore U.S. ports in the Gulf Coast area that actively trade petroleum are located in inland harbors and are connected to the open ocean through shipping channels or navigable rivers. Although these channels and rivers are regularly dredged to maintain depth and enable safe navigation for most ships, they're not deep enough for deep draft vessels such as a fully loaded VLCC. To circumvent depth restrictions, VLCCs transporting crude oil to or from the US Gulf Coast have typically used partial loadings and the process of ship-to-ship transfers, or lightering. To accurately estimate US crude exports, we need to account for lightering in our analysis of trade flows data to avoid double counting of crude that is first transported in a smaller tanker from a US onshore port to an offshore lightering zone and then transferred to a larger tanker for transportation to its ultimate destination port. For this purpose, we compiled a list of loading and discharge ports to exclude from the trade flows data set. Flows are segregated based on their load and discharge port or berth characteristics to avoid double counting of ship-to-ship loads. Only ship-to-ship loads with the discharge country other than US or US Virgin Islands, and shore loads with the discharge country other than US or US Virgin Islands are counted towards exports. To allow us to demonstrate that trade flows analysis can be done for a specific pad, we are adding the port zone info to the data frame. In this example, we're only going to consider pad 3 exports, which is the area around US Gulf Coast, which accounts for the bulk of US crude exports anyway. To achieve this, we're filtering flows with the tanker zone as US Gulf. And then we can pivot the table to aggregate the flow by departure month and also add Canada imports via pipeline. To visualize how well our estimated PAD 3 experts compare to the official figures from EIA, we're using another API call to retrieve the time series for EIA US PAD 3 crude oil exports, construct a comparison table, and plot the time series. As one can clearly see from this resulting chart, Refinitive flows data for seaborne exports historically tracks the official EIA figures with very high degree of accuracy. The advantage of our estimate over official EIA data is, of course, that our estimate can be performed in real time. As you can see from the chart, or as I mentioned earlier, the latest figures available today from EIA are for February, and the trade flows data that we have at Refinitive are up to the minute. In this visual, again produced from the trade flows data, we can see the story of how US crude exports from the Gulf of Mexico ports grew from 2015 to 2020. Before 2015, US was barely exporting any oil. At the end of 2015, the legislation was enacted that authorized the export of US crude without a license. This legislation, combined with shale production boom, resulted in US producers starting to export significant amount of oil to get better value in international markets, particularly from countries with significant demand for light sweet crude. We can also see that it took a couple of years for the export volumes to pick up. And this is because the traditionally import-oriented infrastructure had to catch up with the demand for exports. Another interesting thing to see in this visual is how Corpus Christi became a major loading port for US crude exports with the addition of new export infrastructure, including pipelines from the Permian Basin and new oil terminals. The next visual I have here depicts the flows of US crude by destination. We can see that in the last couple of years, in 2019 and 2020, the top 4 countries in Asia, which are China, India, South Korea, and Japan, emerged as the major importers of US crude. In 2020, these 4 countries imported 340 million barrels of US crude. And the second largest destination for US crude is now Northwestern Europe, which in 2020 imported 250 million barrels of US crude oil. Here, I'm putting on the map the country destinations of US crude. Exports that were originally back in 2015 were pretty much limited to Canada. picked up pace to other parts of the world, especially to Northwest Europe and Asia, starting in 2017 and 2018. As Chinese refining capacity grew, the demand for US crude steadily increased until 2019, when trade wars caused a sharp drop in the imports by China. While the volumes went to South Korea and India, this raised a lot of friction between US and China. And in 2020, the two countries agreed on a mechanism to resolve trade dispute, under which China was to reduce the trade deficit by purchasing increased value of energy commodities. That, coupled with the sharp decoupling of WTI prices during COVID-19 related crash, led to very strong rebound in 2020 volumes. And now let's take a look at the rationale for a buyer in Asia to purchase oil from the US. Historically, refineries in Asia sourced most of their crude from Middle East, West Africa, and Latin America. In the last few years, US crude emerged as a viable alternative. For a crude buyer in Asia, the alternative between Middle Eastern and US oil comes down to which commodity lands cheaper at the refinery when accounting for all costs, including the commodity price and the cost of transportation. In this analysis, we're going to consider only these two variables, the oil price and the transportation costs. It takes roughly a month longer to transport crude to APAC from the US Gulf than from the Persian Gulf. This means that US oil arriving at the refinery in Asia would have been loaded a month earlier than the Middle Eastern oil arriving at the same time. To account for this time lag when comparing the benchmarks for US oil price versus the Middle Eastern oil price, we take the price of the nearest month WTI future versus the price of the second nearest month of the Dubai-Singapore swap. Or alternatively, we could take the second nearest month WTI future versus the price of the third nearest month W-Singapore swap. Here in this block of code, we're obtaining the prices for WTI, month 1 and month 2 contracts, and Dubai-Singapore swaps for month 2 and 3. We also retrieve freight rates for loop to Singapore for VLCCs and forward freight agreement or assessed fair forward freight value for Corpus Christi to Japan for VLCC. Then we aggregate the data and create a scatter plot. A scatter plot of trade flow volumes versus the spread between the US and Middle Eastern oil price on the one hand, and the VLCC forward trade value for Corpus Christi to Japan on the other axis. The gradation of trade volumes that you can see here towards the lower end of the scale for forward trade suggests that in drawing volumes toward the continent, the forward freight is a bigger factor than the spreads between WTI and Dubai. While the spreads are important, of course, the value of freight appears to be a bigger motivator for Asian buyers in deciding whether to purchase crude from Middle East or from the US. Such analysis can help extract more value from data in making trading decisions. For instance, one could conceivably use a sample to test a hypothesis to see if US crude would be more attractive in a contango price environment, as it would have been purchased earlier than the Dubai-linked crude. And now, finally, we're going to see if fixtures data could be a predictor of US crude exports. Here we retrieve Refinitive fixtures data through an API call and combining it with our estimates of crude exports from PAD 3 that we compiled earlier. And what we can see from this resulting chart is that Refinitive fixtures show good correlation with estimated crude exports from PAD 3, therefore can be reasonably used as a predictor of the direction or trend of US crude exports. Now, similar analysis can be done for other regions or other commodities. And with that, I'm going to hand the mic over to my colleague, Jeffrey Smith, who's going to walk you through employing similar methodology to analyze the flows of refined products, which incidentally is very timely as it allows us to see the effect of Colonial pipeline shutdown. Jeff, over to you.
Thanks, Alex. So, hi everyone. So my name is Jeffrey Smith, and I'm Director of Oil and Shipping Research at Refinitive. I'm going to build on what Alex has been showing you and take you through an example of how we use Power BI and Python within the oil research team at Refinitive. The example that I'm going to use is quite topical. It's an event that's happened quite recently, which is the Colonial pipeline ransomware attack that happened 1.5 weeks ago now. I think the aim of what I'm showing you here is to show you that because we can get the data or Refinitive data into Python via the RDMS or the Icon data APIs, we can then use other tools. In particular, we can use data visualization tools like Power BI or Tableau, and in this case, we're using Power BI. So in terms of the data flow, how it works, Power BI and Tableau and many other tools, they're able to call Python scripts. So if Power BI can call that Python script, the Python script can then call the data APIs, so the Icon RDMS APIs, retrieve that data, pull it back in, and off we go. So a little bit of background around the Colonial pipeline. The Colonial pipeline is one of the largest product pipelines in the United States. It carries gasoline, diesel, jet from the refining region in the US Gulf up to the Northeast, all the way up to New York. The company operating that pipeline went under a disruptive ransomware attack on Friday, the 7th of May, whereupon the pipeline was closed. Partially it reopened on the 17th and is now sort of fully operational. The oil research team at Refinitive put together reports with their assessment of the impact of this event. And to do this, they needed a holistic view. They needed to look at multiple different data sets, so pricing, stock levels, refinery data, imports, exports, freight rates, to get their view on what's going on. So there's really two steps to this. The first one is pulling the data or accessing the data, and here we're doing it in a Jupyter Notebook, and then we build the visualization in Power BI. So this is the Jupyter Notebook that we're using here. I mean, you could use Python IDE or Spider or PyCharm, and it's a lot of data requests. We've got the main futures, the main prices, the storage information, pipeline storage information, stocks, gasoline demand figures, freight rates, a lot of different sources. We can then pull that into a Power BI file. So this is the actual report that we pushed out on or published on May the 12th. You can see it's structured as 4 sheets. So we've got the summary sheet here, where we've got sort of some commentary and sort of the main prices. We've got some regional prices, some storage figures, and then finally some import-export values. So one of the sort of very powerful things about Power BI is that once you've built the report, it's very easy to refresh. So this report was built on the 12th of May, but because I've refreshed it, we can get data like up to now, and we can monitor the events and how it unfolds. So just some points to note, I suppose, about the events. So here we see, so when the events, or as the news unfolded about the pipeline outage, we saw a rally in WTI and RBOB. So RBOB is this main US gasoline futures, which over the week after actually came down again. And I think it became pretty clear that most of the market thought the pipeline was going to reopen pretty soon. It wasn't going to be a long event. In terms of cracks, so a sort of a measure of the profitability of gasoline, so comparing gasoline prices versus underlying crude oil. In the US, we saw that the cracks at that time actually increased slightly, but the European cracks decreased. Looking at sort of regional prices, so the thing that really grabbed the attention in the news was the increase in prices on the petrol station forecourts. That did ramp up above $3, which it hasn't done for quite some time. In terms of the differentials around the region, as you'd sort of expect, the prices around New York kept high. Chicago was actually just is lower. During the period it's kind of flat. And in the US Gulf, where because the pipeline was shut down in the refining region, you'd expect a glut of gasoline, and yeah, we saw a slight decrease there. In terms of inventory levels, so when the pipeline was shut down, when the event hit, the inventory levels were sort of slightly below average, but I think the data point that's really important here is the stock levels in this low Atlantic 1C, so PAD 1C region, and this is where there was a lot of people sort of panic buying gasoline, filling up their tanks. I think in some ways, because there's so many people doing it, people were running out of gasoline, trying to find petrol stations that they didn't have to queue for, and a lot of petrol stations ran out of fuel. And then finally, looking sort of import-exports. This is based on our trade flows data. So we've got sort of weekly imports, imports by month. We've also got the ARB, so the comparison of the US and the European prices and the freight rates. And during the events, there was a spike in the difference between the US and European prices, the ARB. But also we saw a spike in freight rates. So, if the pipeline was out for an extended period, we would expect, that gasoline's got to come from somewhere, and usually it would come from Europe. When the event started, there was a lot of interest in chartering these vessels. Hence, we saw the increase in freight rates. But over the week, as it transpires, the pipeline came back into operation, and those freight rates have come down. And here we can actually monitor the numbers. So what the current week, last week imports, how the month is coming along, and which the specific vessels are. Okay. So hopefully this sort of summary shows a real life use case of sort of how we use these tools within Refinitive within the oil and shipping research teams. You can see how we've able to access many different data sets from Refinitive, including from our trade flows data through to prices and pipeline storage tanks, to get a view on events and be able to put this kind of research together in a very timely fashion. So that's it from me, and back to Candice.
Thanks, Jeff and Alex, for the excellent demos. As they've shown, third-party data platform solutions such as RDMS ensure companies are able to leverage big data and technology to really help drive value along the digitalization journey. So with the remaining time we have, we're going to move on to Q&A now. I am going to have a look. Just give me a second. Right. Okay, we have a question here, and I think if I can ask you this question, Jakob, if I may, what are the most desirable attributes for a trader succeeding in these markets today?
Thank you, Candice. Yeah, great question. I guess in 2 words, insatiable curiosity, which I think is part of the stable diet of a good trader anyway. But I think we're just taking it up a notch. For years, I think cross-commodity trading had been justifiably in vogue and always appealing to those with a natural curiosity. But I think what we're seeing here and what this session's been all about is actually the additional layers that are being added. So more complexity, more connectivity, obscure or otherwise, between markets, and then, as I referred to earlier, the impact of global money flows and capital allocation. So this curiosity, which I see as a natural part of a trader's DNA, will have so many more sophisticated tools at their disposal, a much more interesting toolbox, which again will feed that curious mindset. Fundamentally, a strong trader needs to have all of the above, and then a healthy amount of conviction in their DNA as well. So I think, yeah, those are some of the bits that springs to mind when I'm thinking of a trader in today's marketplace. We can talk about, we can get right down to concrete levels of should you or shouldn't you have a deep understanding of Python. I'll leave that to people's own judgment. Clearly, it's of no surprise that having a considerably well-developed quantitative mindset will be a good place to start. But I think on a more personality trait point of view, I think just having that built-in crazy appetite for information and curiosity of consequences in the market and how one can monetize that.
Fantastic. Thanks so much for that, Jakob. Just wanted to see, Alessandro, do you have anything to add for Jacob's response?
I really like the angle, the curiosity angle, because right now what we're seeing is that there are several technologies out there which are currently being explored and adopted by the oil trading companies. So I would say that we're in the middle of an evolution, or to be probably more precise, of a planned disruption, to quote the chief information officer of a big trading house here in Switzerland. So curiosity, I think, it's really key. And as we mentioned earlier, do get in touch with your senior management and see whether there is alignment and they can support you into this digitalization journey.
Fantastic. Thank you so much. Just going to have a look. Yeah, we've still got time for a few more questions, I think. Okay, so I've got here that is, maybe I can come to you, Jeff. What is the source of the trade flows data?
Right, okay. Hi, Candice. So trade flows is our cargo tracking system. It's based on computer algorithm and analyst inputs. We have lots of different data sources. We collect vessel position data, port data, lineups, fixtures, port inspections, customs, you name it. We go to the market as well to get particular data points. We merge that together and we run computer algorithms on it. So quite sophisticated. Computer algorithms generate the flows, and we also have our analysts sort of input as well. And then that runs many times a day, which we then push out to into Icon and other Refinitive products, but specifically also the into RTMS. So if you need a feed of this information, you can pull it into Python and Power BI or other data visualization tools. Okay.
Thanks for that, Jeff. Actually, I've got another one. I think maybe you can also help answer. Why do you use Power BI and not Tableau or something similar?
Oh, that's a good question. I think the tools nowadays are extremely powerful. There's a really healthy competition between Microsoft and Tableau. For us, we use Power BI because we have a license. It's part of our company Office 365 enterprise license, which means everyone can use it, everyone can publish, and everyone can read the data. It's not a sort of a technical requirement. And yeah, we found these kind of data visualization tools extremely powerful because not only can you automate things, but the quality of that data visualization and what is then available to you is much sort of wider than you had before. So yeah, we really enjoy using these tools now.
Thanks, Jeff.
And Candice, if I could add to Jeff's point, the beauty of our solution is that it's agnostic. So our clients are using Power BI, some others are using Tableau, some others Spotfire, or any other visualization tool which is out there. But it's also agnostic from a data point of view. So you can ingest data that is available in Refinitive, but you can also use your proprietary data. And we know that our clients produce tons and tons and tons of data, and not all of them until now were actually able to act upon proprietary data. So what is really interesting is to see how people can commingle different sources of data, whether they are coming from the market, via us, via other maybe feeds out there, but also their own data that they have in-house.
No, that's completely right. I agree. Thanks so much for that, Alessandro. I think, in terms of the time, we're actually coming to the top of the hour. So this concludes our session today, and we'll make sure we answer any outstanding questions over email. We'd love to hear from you, so please do get in touch with us should you have any further questions or if you want to learn more. You'll receive a recording of the webinar along with useful links such as the article of the use case Alex went through with sample Python code, and also a link to our developers portal where you'll be able to find quick start guides, useful documentations for RDMS and Icon APIs, as well as our lively Q&A forum for developers. And please do visit refinitive.com where you'll find details of future webinars and our data catalogs, which will link you to our commodities data content set. And with that, I would like to thank all the speakers today, and thanks very much, and also the audience for your time today. And I look forward to hearing from all of you very soon. So this concludes our webinar today on digitalization in commodities. Have a great day and goodbye.
Thank you, Candice. Bye-bye.
Thanks, everyone. Thank you.
Thank you.
Thank you. Bye-bye.